Hello, and welcome to the NatWest Markets Weekly Watch. I'm Brian Daingerfield, the co-head of G10FX Strategy at NatWest Markets, filling in for John Briggs. Labor Day is now behind us, and with it, we're starting to see some signs of the changing of the seasons, including pumpkin spice coffees, NFL football, and of course, cooler temperatures. But as temperatures cool across the Northern Hemisphere, so too should demand for energy and natural gas rise, offering a somber reminder of the challenges facing the global economy from surging energy prices. In Europe, fiscal stimulus is being employed to attempt to mitigate the rising cost to consumers. As we record this episode, for example, new UK Prime Minister Truss has just announced the details of her fiscal plan to blunt the energy price impact for UK consumers. But employing fiscal stimulus is not a costless endeavor for any economy. And one obvious potential repercussion of fiscal stimulus is that inflationary pressure could start to increase. Also, higher deficits could also accompany new fiscal stimulus. For monetary policymakers, fresh stimulus could also force some authorities to take an even more hawkish tact to try and rein in some of those potential inflationary pressures. Our UK strategy colleagues, for example, updated their Bank of England call this week, now seeing the policy rate rising 50 basis points at the upcoming September meeting, and raised their terminal forecast for the bank rate from 3% to 3.5%. As we head towards cooler temperatures and a potential recession here in the US, we should also be asking a similar question regarding US monetary and fiscal policymakers. What appetite exists for additional fiscal stimulus should the US experience a meaningful downturn in growth? With that backdrop, this week we updated our outlook for the US midterm elections in November. Our core expectation remains the same. Democrats' prospects for keeping the Senate have improved, but Republicans remain the clear favorite to reclaim the House. That result would imply split control, and as a result, legislative gridlock through the remainder of President Biden's first term in office. Keeping the Senate would only be a consolation prize for Democrats, and it could help them with future appointments to the Supreme Court, for example, or future Fed appointments. But losing the House of Representatives alone would be likely sufficient to lead to legislative gridlock, with the Democrats controlling the presidency and Republicans controlling the House of Representatives. Fiscal stimulus fatigue among centrist Democrats is already high given inflation, but the prospect for counter-cyclical stimulus in the US likely falls even further as Republicans take House control, and that may lead to more partisan bickering in 2023 and beyond, rather than policymaking. Of course, these concerns over the medium-term picture for monetary policy and fiscal policy are medium-term in nature. Over the short term, we're going to be looking forward to the CPI next week as the key data point to decide whether or not the Fed is able to slow down their pace of tightening from current rate of 75 basis points per meeting to something slower, say a 50 basis point rate increase. That's likely the key data point in the near term that's likely to determine the path forward for the Fed. With that, thank you very much for listening. If you enjoyed this podcast, please be sure to consider liking and subscribing to our channel for additional economics and market strategy content. Thank you.